Hi everybody, Terry Bell here from Bell & Company. We're starting in a couple of minutes. Good afternoon to everybody. Hope you've had a good week. Not ending on maybe the sexiest subject, but something very prevalent in our world, and I think something that we all need to be aware of. I'm sure if you are attending, it's some sort of vested interest, whatever that may be. And whilst we don't know everything, knowledge is a good thing, and we do this day in, day out. So we'll just give it another minute, if that's okay, to make sure we get all the people that want to attend. I think we've got about 80 odd people joining us today. So that's useful enough. This webinar demonstrates our findings so far, so early in the process here in terms of what's going to be happening here. But we're very attentive to the news and the updates and everything else. So, like to think we know what we're talking about. And we're nearly seeing this as potentially the straw that can break a few camels' backs here, because it's going to bring extra duress, unfortunately, onto business. On a personal note, I speak fairly route one because it's what we do. We're compassionate people. We're very empathetic with our clients, but this is what it is. So I've done all my apologising for the recession, that whatever form that takes coming forward, but we've got to get on with it now. So I'll get going here. We're going to firstly give a little bit of a background, obviously. I'm sure most people know these facts, but it just gives the context of where we are and the appropriateness or otherwise of the bibbles and sibbles. So we had the bounce back loan, we had the coronavirus interruption business loans, 50 grand for the bibbles, 250 on the sibbles and higher. I mentioned the 250 limit because that's when PGs weren't required up to that level. We think that they should have been called CISLs, which is complete closure loans. The clue is in the name. Bounce back, unfortunately, for our friends in hospitality, particularly on retail, that's been complete closure. We've had pubs that have been closed for 80% of the year, and all the other issues. Not just opening, it's restricted opening, it's the maintenance, etc., etc. Certain industries have endured complete closure. We have a number of restaurant clients, particularly in London, and we're finding that the pressure that's bringing to bear to trying to open now. I have a friend in Harrogate who has a restaurant, and he's opening just to make sure, in a restricted base, to make sure people know he's still there. So it's a temporary relief measure, bounce back, as the name suggests, and or interruption, which has been more than an interruption. Now, in the speed to get the loans out, obviously there are due diligence issues for sure, and that's going to be a crisis, in inverted commas, down the roads. That's our friends in mainstream media like to obviously blow everything up and how awful it's going to be and everything that Rishi, our good friend there, did wrong, da-di-da. But there was an article in the Sunday Times, and it gave a little bit of context to some of the things that have been going on. And there was a comment from a firm of solicitors called Edwin Coe, and they were referring to the fact that they've been appointed to act in a case where the client took his 50,000 Bibbles loan and used £25,000 to pay off his drug dealer. Genuine case, it was in the Sunday Times, and the other 25,000 was put on account with his drug dealer. We've seen an instance of a car dealer in England that used £150,000 Sibbles to go into the hot tub business. And he's done actually quite well out of it, which then helped to. So there's going to be lots of news, and it was abused and everything else. I'm sure it was, but as we come down a bit later, I see it more as a grant scheme. Yes, the vast majority are going to be chased and have got to be paid, but there are slightly different agendas behind all of this. So in terms of the differing loan terms, we started off, what you were given in terms of a Bibbles or a Sibbles loan, and then other clauses have been added in terms of the ability to extend the payment out for 10 years. That's why I call it nearly a bit of a grant system here. The interest rates have been, in the main, excellent, very low rates that give us that time and our businesses to react and recover here. And over the future, I think there's going to be different levels of leniency to how they're going to assess that. I don't know, but there's going to be some sort of leniency. I don't think too many people are going to get hot and heavy to start with, and we'll just see how that pans out. Then Sibbles and Bibbles, I know finished on the 31st of March. And now there's another scheme to back this up if required, the recovery loan scheme. And that it's early days, but what we're hearing is it's going to be a lot tougher criteria, almost reverting to the finance availability prior to COVID. And the interest rates are going to be, there have been some rates, 18% quoted, which are pretty savage. So something else to replace it, but it's almost like they're trying to wean us off and we're going to take you somewhere else that isn't so nice if you want it. So that's the thinking there. Then in terms of, just as a background comment, my opinion only, this has been used in different ways. Obviously, the support has been massive for business. If it wasn't there, and across the world, I listen to quite a bit of news outside the scope of the UK and Ireland because you get context. So about the Swiss scheme was fantastic. America's doing what it's doing. Everyone's doing it. So if the support wasn't there, obviously the economy would have completely fallen off the side of a cliff. Quite a few businesses have used it for investment purposes, which is if it's there and it's available, more power to your elbow. Some strange other uses as well. I've seen Sybils. I've seen people use it to buy companies, use Bibble loans and Sybil loans to go and buy other companies. I've seen development finance, quite a bit of development finance, for instance, assets, doing Sybil's development loans. And I've even seen HP loans that have been lent on a Sybil's basis. I think the basis of a lot of that would be giving the lender more security, if you like, with the government-backed element of the loans that's going on for those that go wrong. Now, that's going to be interesting how that pans out. A few figures to kick around here so we get the context again. About 1.5 million of these loans have been taken, and so far there is 75 billion been lent by any number of a plethora of lenders, small, big platforms, big four banks, etc., etc. A worrying statistic which saw an article in the FT quote that 42% of those that took Bibbles loans, those up to 50 grand, didn't intend to pay it back. And as a couple of people have said to me, it was easier to get a Bibbles loan than it was a car loan. So we know that's going to cause some problems, but it could be there for a reason. It could be one of Rishi's grants, if you like. He would never call them that, but you can see if half that 75 billion gets written off, that will be 37.5 billion that went into the economy at an important time. Not that our friends, as I say, they're our friends in mainstream media, excuse my teeth, said that they would create a banking crisis. But obviously they love the bad news and that's coming. Then we've got the most vulnerable sectors that have taken all the loans, which are construction, hospitality, retail, always unfortunately top of any insolvency stats. We're quite sad. We get our insolvency stats every quarter and they're in it. We know particularly hospitality and retail have taken some savage blows. Within reason, construction's got through, and there's been quite a bit of infrastructure stuff going on here in Belfast, Leeds, I've noticed, and in London. So that seems to have survived through where we are. And we've a couple of developer clients that have continued to develop right the way through the process. So a little bit of a backdrop again in terms of where we are. Now, this isn't to suggest people listening into us today are in any way involved in any fraud, right? The key thing is the point on the right there. And again, it was in the Sunday Times article, and they're talking to people in the know, they're talking to government bodies, etc. And one of the key things they're finding one of the main things they're going to be looking for, they say that probably the clearest indicator of fraud or intention to commit fraud is actually the first mispayment. So if you do have friends, family, associates, clients, whatever, who are struggling, maybe there's a little tip in there. Start paying a bit if you can to get through. Take yourself out of that net. Don't be tarred by the brush from those who have undoubtedly used and abused the system. The ONS, OBS, every other government body in the world, they're doing loads of surveys in here. Obviously, none of them are good news, but they've already detected 1.1 billion of fraudulent loans since they started the process. We've got a lot of abuse from organised crime. Try not to smile there, but you've got to admire their creativity. But it was there to be had, and indeed it was had, and that money will not come back into the system. We will find as we go through that the official receiver should, and that's a big should, and I'll come back to that at the end of this sort of section, should start to get a lot more involved in investigating any element of fraud in respect to the receipt of Bibbles and Sybills. That I say should because it's whether they have and I'll be slightly rude here, the appetite and the aptitude to follow that through. But being a cross-government body, you would hope that they would do that. Now, if there is that element, and that's the official receiver going to start getting involved in the further investigations, similar to when they look at directors' disqualification, the argument needs to be ready there and the documentation in place as to what happened to the money when it came in. Just a simple thing. It's almost like the rugby phrase, get your retaliation in first, over-prepare, etc., all those cliches. But that's the official receiver will be looking at a fraud element here. And then it's the obvious things that directors who misled in terms of loan applications could face prosecution, company's liquidation and or disqualification. Again, I'm casting no aspersions on anybody as to the fraud side, but be very aware of that point there in terms of first missed payment. I think that's going to be a real key one going forwards. Payback time. So we at the great time when the Bibbles and Sibbles loan schemes were announced, and the next level up, which I can't remember what it's called, but for the EasyJets of the world and the BAs of the world, the great big government supports, great saviour. But again, for bounce backs and interruption, grossly massive shutdown in terms of the economy, obviously. Again, back to our friends, hospitality and retail particularly, but across the board. And it's amazing how that filters down into different areas. So we have a client who's a fish wholesaler, absolutely on his backside, doesn't know how he'll recover from where he is. So we've got to think of that through. Now, obviously, now it's repayment time. Hopefully, anyone that's got these loans, if they haven't done already, it's to make sure they renegotiate their terms in terms of the term of the loan. I don't think you'll get a better interest rate, but no issue in asking. So you get it down to, a really manageable amount. Now, these repayments are obviously a burden on businesses just opening. Businesses we already see it. You may see the mad scenes in London and Soho, and we're on the streets and we're having a great time. Right? It's still a low percentage of the turnover prior to COVID. Somebody I know who's opening a place will lose money until we get everybody back in the restaurants. That can't go on forever. You may have had a business may have had an issue prior to COVID. Then you've got COVID itself and everything else. Well, that's done to the business. Now you've got a bit of debt over and above, and you're sort of fighting with one arm behind your back while we have the ongoing restrictions. Touch wood, as we start to go through the vaccination process, I've been done, then that will filter out. But it's very difficult for business to find that level where they are. And then at the same time, I'll skip on to point 3 here. We've got a couple of things coming to an end. You've got the furlough, obviously, filtering away. HMRC deferment schemes have ended. I think I'm hearing different things. I'm hearing very, very subtle stuff from the Review versus they want their money. So we'll see where they sit here. Again, a government body, so hopefully there's a bit of joined up thinking and there is a bit of latitude there. They need their money, but we need latitude. The rates relief very quickly will come to the end. And obviously we're talking about civils here. So we've got that, the backdrop that a lot of it's not going to be paid. There's the OBR there talking about 26 billion not getting repaid, but they will be asking for it and they've got to go through the consequences of any action to recover that, be it liquidation or whatever they have to look at. We've also then got the backdrop going back to the pre-COVID existence, and that was already prior to COVID, but during this period here, companies become zombies. By that, we're talking about the companies literally existing and subsisting to work for the banks and the finances of the business, the creditors, etc. And typically companies become zombies because of the fear, particularly of directors, of in some instances, directors' loan accounts being overdrawn and they don't want to be rumbled, and or personal guarantees. So we experienced this back in 2009 when we started here in Belfast, and any number of companies stayed alive and spluttered, and excuse my parlance, and farted along the way trying to survive until it came to a stage where we've got to face a personal guarantee. Personal guarantees don't go away, unfortunately. We've mentioned this before. And so we would say this, but it's always a case of attacking a problem. Do not become a zombie company. It's not healthy, full stop, in any way. Financially, for people's own health, mental health, etc., it's not good. But that will happen as people try to survive and get through this. And it's very, very tough call, but don't be a zombie company. So we're going to have a little bit of a projection of how things work. Now, the reason we've given that detailed graphic on the left, that is, I think, copied from the British Business Bank website. These were the authorised lenders in terms of Bibbles and Sibbles. So you've got the big four in there, but you've got fintech platforms, second level banks, if I upset Co-op Bank and Ulster Bank and the like, that stage there. But the fintechs are the one that could be the challenge here. And you call out your names there. We deal with them, so I've got to be very careful what I say about them. Now, because the scheme is government backed, that doesn't mean government protection. Okay, so a lot of people are under the impression if they don't pay it, the government will pick the tab up. Ultimately, they will, but there's still got to be a process. It's not going to be a case of somebody saying, I can't pay my Bibbles and Sibbles back, get lost, and the bank go, okay, dead on, and then go to the government, go, Rishi, they can't pay it, can you pay us? There's got to be some recovery process here. And it's how far that's going to go, given the backdrop of what I was saying, where Rishi's really putting quite a bit of this money in as a grant. So you've got the 75 billion, half of it, or whatever the figure is, isn't going to come back, call that a grant, if you like. How aggressive can they be in terms of collection? Now, we're going to give you a couple of bits in terms of our insight, because we deal with at least half of those companies there. Sorry, I was just catching myself up. At least half of those companies there with their lovely logos and everything else. Okay. Now, I think there will be, each and every lender has a different process. Some of our fintech platforms are particularly aggressive. And quite a few of our fintech boys there are actually glorified brokers, not actually lenders. So they have different agendas, right? I've said there rather boldly, and I hope this doesn't come back and bite my backside, the big four banks aren't great at chasing debt typically. They are very systems-led. The number of times we see clients getting automated letters that aren't even signed, for instance. And we know here, for instance, in Northern Ireland, Dansk use a facility down at Dunmurray, and nobody knows why that letter's gone sometimes. So I think that'll be a slow burner, but it's still going to be something. If they want their money back here, you know, they've still got 20% potential exposure if the government does pay the 80%. So they've got to find a way to do it. They can't just pay lip service, I don't think, to it as we go through here. So the misnomer that we've got government backed, therefore it's government protection, even for the borrower, is wrong. The best way to look at that and give evidence of that is with what was the Enterprise Loan Guarantee Scheme, where the government will back a scheme that the bank would have lent the money, but there wasn't essentially enough security. And the government would step in. There was a fee for that protection. I think it was 75% of the loan. But the bank still had to go for the people if the business failed. Either after their 25%, no, sorry, other way around. They want their 75% back from the government, and they've got to prove they made efforts to recover that. Again, they're not going to just dish the cash out. Also, then they've got the 25% personal exposure on the borrower, potentially. So they've got to go through that process. There's going to be it's going to be quite a dog-eat-dog period for a while. I think the fintechs, when some of these start going wrong, will go absolutely nuts with it, because they're going to need that recompense back. A lot of them have had a good run at this because, again, they've been able to write a load of business here, and I will question some of the due diligence, especially on the Bibbles. Now, this myriad, we're finding this increasingly prior to COVID, this myriad of lenders complicates the process in that very often you've got 2 or 3 different types of lenders. So you could have a clearing bank, let's call it Barclays, and you could have, say, another clearing facility that could be, I don't know, Monzo Bank, okay? But then you could have 3 or 4, you could have an asset finance, you could have a peer-to-peer loan, Funding Circle being the most prevalent ones in the market, and you could have that mix. Now, in the last recession, typically it was a one bank wonder. So across the square here, is Ulster Bank. And what we'd very often find is the client had their mortgage with them, their own current account, a credit card, the business had an overdraft, a current account, and it also had a business loan of some sort, say on some assets, all in one bank. Now it's not a lot more complex, a lot more difficult to project. So I'll give you an example here of the complexity that can happen here. We've had an instance where one client had 23 fintech loans, and they're out there for every reason, out there for tax grants, they're out there for invoice discounts is quite often used by the fintechs. Anything and everything is now available on some sort of fintech loan. So if you've got a mix of those, that's in a sense, that should be sensible when you spread your risk. When things go wrong, you're as good as the most aggressive creditor. So if one of the fintechs is in a desperate place themselves, which some of them are, especially on the property side of things at the minute, they can be very aggressive and go hard at you for it. And they might not be the biggest creditor, but they want their money back and they're going to do whatever they do. So that's why we're saying it's going to be quite a complicated process. And we had a client there who had 7 fintech loans, we'll call them. And what his position was, he was under a bit of pressure. He was struggling to deal with it. And that's not a joke. He was as I call him, a hairy ass builder, build all day, but couldn't deal with this. And that's the makeup of the man. That's not a criticism. But we said, right, you could fight all 7 here. And I think he had about 400 grand on those, 400,000. And he had about 100 grand of equity in his house, which he shared with his wife. We suggest if you cannot take the pressure, one of these will turn on you, undoubtedly, and, could put your lights out anyway. Consider personal bankruptcy, because he had personal guarantee exposure on all 400,000. So this is where we're saying, if that's going to be the issue. I think differing organizations taking different attitudes. Some of them I think the big 4 within reason will be lenient and or hopefully slow, whereas you could get a fintech fighting through its very existence. We don't know what's going on behind closed doors here, and they may come straight at them. So that's the backdrop we see panning out over the next 12 to 24 months. Then we are going to have a situation where the potentiality of collection agencies are going to be involved, and or vulture funds. Vulture funds slightly separately we'll deal with in a minute. Sorry. Excuse the parlance. Now, in terms of collection agencies, at one point, the big 4, Barclays, HSBC, etc., were looking at bringing one collection agency firm in to deal with all their bad loans that are going to come out, Sybils and Bibbles. Now, they've sacked that idea, so suddenly you're going to get different agencies doing different things. Historically, not brilliant at collecting money. They do collect some money, but again, they've got a slightly different brief. If it gets further down the track, invariably, when banks, fintechs, and everything else create what's called a delinquent loan book, so they'll work through it, whatever we can get. If there's still stuff they think they can collect, but it's almost like too much hard work, that loan book will be sold as a delinquent loan book, and that will go to vulture funds and the like. We call them vulture funds. They're hedge funds and everything else, as we know, but different ballgame. So that's down the track, but it wants to be in everybody's eye line there. Then, as we say there, you've got the banks versus the peer-to-peer boys. I call them fintechs, but in that instance, we're saying peer-to-peers. All different agendas, but we always say this because obviously we want to get people to be urgent and get on with things, because that's our job here. But whatever the instance is, if it is bad, the time is to act now. Even if it's preparatory rather than actually doing anything about it. Get your affairs in order, know the options, talk to plenty of people. Don't go just say to your solicitor who helped you buy the factory or dealt with the divorce or dealt with Aunt Agnes's will. There needs to be specific commercial solicitors who can give you a bit of an idea and a bit of protection. But do something about it. Don't let it happen to you. So that's a little bit of a projection we think of how this is going to pan out in the immediate term. So Going to be quite short, this, obviously, because we, very early days, we just want to put it up there that we're going to be on top of this. We are going to be reporting it through our various channels in terms of what's happening out there. MSM, I can't stand the mainstream media at the minute. The way they conduct themselves through this are going to be all over it. What we always try to do is cut through that crap. I'm not going to apologise for that language, and see what is really going on. We keep ourselves abreast. So we're going to be putting stuff out. We're going to keep people posted. Now, what we did do, we invited some questions, and we've got 3 in. They're a little bit open, and I did try and contact a couple of people, but they weren't too fast in giving us any more details. So I'm going to work around them. So we've got 3 questions here. So there's a guy here who has a business, and he's got a Sybil's loan, and there's no personal guarantee. Now, his concern is his business is going to struggle and his other personal guarantees, but he thinks the Sybil's debt is almost like the death knell for him because he can't take any more debt. His business can't. He's in a form of hospitality. You have to protect him on that things. Now, he's worried about he's taking it as though the Sybil's is the issue, but he's got other personal guarantees. We respectfully suggest to him that the Sybil's isn't the issue. Within reason, that can be managed over the next few months. But what is the real position with your PGs? That's what is going to happen when we do start to get back in earnest. Everyone back at work. We see how all the cafes, sandwich bars and everything else, whether they will survive. If only 70% of people are coming into city centres again, obviously they're taking a hit on their revenues there in that sense. Footfall's not going to be there. So all that's going to come there. But what we're finding now, as soon as we start paying the loans back, that's the reality check, right? Where actually am I? We've had any number of businessmen and women, property owners, we work in Spain, hiding behind the lockdown, right? That's cool because it's nice and quiet. There's no one shouting at them and everything there. Now it's reality time. So this gentleman here is seeing the Sybil's being the issue that could tilt him into having issues with his PGs. Deal with the PGs then. That's a simple process. Sybil's and Bibbles can be managed in the short term. It's a case of tidying up what we do here. Now, the next one was a sole trader in a very niche field, which I'm not going to say because it's so niche. And he took a Bibbles because it was there and available. Now, he did need to use that finance to sort out when he did stop. Wasn't going great anyway, so he tidied up his creditor book, took the pressure off there, sorted a bit out the revenue, basically spent most of it. I think he's got about 10 grand left. But he's a sole trader, so he will be liable. He's asking, is he liable? He's going on the government protection side of things and everything else. He will be liable. They'll have to sort to recover. And he owns his home outright. That was the other fact he did give us. So it's going to be, at the end of the day, if you've got 50 grand over 10 years, I don't know what the repayments are, but they're not too bad. If he tries to take the mickey here, one way or another, he'll get caught on this. And because the bank will have to, they won't get paid out of that in the government scheme down the track. The last one was quite an upsetting one because the reason this hotel will not reopen is because the place has gone to rack and ruin. So it wasn't in the greatest nick before, but now it needs, I think they said about a couple of $100 grand. There's a major problem with the roof. A big hotel, and it's not going to be safe. We call it tatty chic, right? Before it just went down. Now it's tatty, but they cannot open because they got the roof. They got to spend any amount of money on it. It was okay, the business, but they relied a lot on conference facilities and everything else, and they just can't see that coming back. And quite rightly so. Conferences, everyone's got used to this facility, etc. Just not going to happen for 2 or 3 years. Travel isn't going to happen properly for 2 or 3 years. So their problem is they're unlikely to reopen because they've got to spend a large amount of money just getting the place fit for purpose. Now, they've had the Sybil's, and again, they've used that to survive, pay off other loans and deal with it, again, back to the trade creditors and get themselves open. There's a bit of cash around still, but that was there definitely for the business interruption side. It literally fitted for purpose. What we call the complete closure period caused them then to experience these further issues in terms of refurb and upkeep of the building. Big issue going forward. Now, there aren't many options here, really. They've got to face liquidation. But what we have advised this client, it's a husband and wife team, is that just look at your first payments or so if you can, because you just don't want to fall into that, the die cast in terms of you didn't pay, so therefore you're in potentially to be considered fraudulent here. They've got the full story there. Get it up in lights, explain it. Back to the rugby phrase, get your retaliation in first, tell everybody what's happened. That's going to be a very difficult one. And then it does bring into stuff with the banks, the main loans on the property, etc. Because whilst they're not heavily indebted, obviously the values of anything in hospitality is going to take a whack here, because simply they're not going to be en vogue and not feasible economically. So they're a bit open, those questions, but hopefully a bit more context in terms of how we work and how we approach things. All of these webinars, and we do some podcasts, are for us to try and put, not in a charitable sense, but we're trying to share content. We're trying to share some of our experiences, some of our knowledge. Obviously, every case is different. When somebody comes on and says, right, 150 grand, can you tell me where I'll end up? Well, tell us all your details. No, I'm not comfortable with that. Obviously, that's not feasible. So what we're doing with these are snippets. They're not advice. They're experiences. They are my opinions. And my opinions, not Bell & Company's, by the way. And anybody wants to sue me. But it's that context that we try and do this. So anything that stems from this, if there are any questions and queries and everything else, there's an email address there, trb@bellcomp.co.uk, or ring in and say you listen to the webinar, and we'll chat away with it. If you want to take it further and you want us to act, obviously we'll have to talk candy. But as is, it's a free content. If anybody disagrees, please do email, right? If I got anything wrong, please do tell me and I'll put it right straight away. Early days, if you're questioning my opinion, that's what the world's about. If I've got something technically wrong or legally wrong, please do tell me and I'll put that straight. But that's a quick view in terms of where we think civils and bibbles are going to go in the short term. We'll most likely update this sort of form of webinar in about 6 to 9 months. Anyway, that's us. Enjoy the rest of your afternoon and have a good weekend. Good luck. Cheers. Bye.